Good afternoon, everybody, and welcome to our outlook call. First one we've had since the summer. I hope you've all thought on. Okay, very simple format as normal webinar. If you have any questions, please put them in the chat box or raise your hands. We've got Gary will give us a 25-minute overview of the markets, which are very calm and relaxed and quite boring at the moment. And then we've invited Marshall Jen, who's going to come in and talk to us about succession planning within family offices and the family office business. Gary, let's hand it over to you. Powell was quoted of risk management, which is clearly related to keeping his job as opposed to anything else. 25 basis points cut. Give us where do you think we're going?
Yeah, and I'm going to concentrate on the environment that the Fed's working on, but then talk about the broader picture because there's lots of good stuff going on around the world, and I think often people miss the good news. So let me just pull up my presentation here. It's coming up. Here we go. Yeah.
So there is good news, Gary. There is good news.
There is good news, yes. Oops, good.
Issue.
Okay, hopefully you can see that. Is that all good?
Yes, we can. Yeah.
All right, great. Okay, so it's post-Fed. What next? And I suppose I was just trying to take a picture of what I kind of look like from a picture. A picture speaks 1,000 words, but I think there's a lot of it, not just economists, but people looking at what happened at the Fed meeting. You know, on the surface, just a simple 25 basis points cut in interest rates. But actually, there's a lot going on. And I think people have got to be on top of the stories, you know, the way in which things are evolving, the differences from the past. So let me just get into this and just spend the next 10 minutes trying to explain what the Fed's looking at. In terms of the FOMC meeting, what did they say? Well, extraordinarily, they reduced their unemployment forecast. They actually increased their inflation forecast. And even though they did both of those things, they cut interest rates. And as Dave just mentioned, Jay Powell just mentioned, by the way, this is a risk management cut. So a lot of my presentation is about all the reasons why they really perhaps shouldn't have done anything. But clearly, people are concerned about the unemployment rate, that it might, move up very rapidly, but that's not in the forecast. And I think, as we see in history, central banks typically get it wrong on inflation, i.e. they underestimate the pulse of inflation when it starts to emerge. So let me just get into interest rates. We now have an interest rate in the United States of 4%. Now, I think the problem for economists is that if they kind of just grew up in the last 15 years, they're used to somewhere between 5 and 0. And it's very, very difficult to work out what do we think the normal level of interest rates is from the US economy. And you can see if we go back in history, we had numbers at 15%, we had things typically at 5%, then we were down at 0. A number of 3, which is what they forecast as the normal rate of interest rates, just doesn't appear there. It doesn't. We don't see a nice solid line at any point that says 3% is the right number. So we should never put central bankers on a pedestal. We should always question it. And I just say, the answer is probably somewhere between 0 and 4, but it's not necessarily 3. And it doesn't mean that the Federal Reserve is going to cut rapidly as we go through 2026. So, and just on real interest rates, so if you adjust it for inflation, again, the answer has been somewhere between +2 and -2, which is a very, very broad range. And you can see from this picture, we have been at extremes in recent years. So let's just start with academic. Academic studies say that there's a relationship between inflation, unemployment, and the interest rate. And so if we feed into that model put together by a man called Mr. Taylor, the Taylor rule, the answer comes out at somewhere between 5.25 and 3.75. So with yesterday's cut, we are in the kind of called the doves side of the argument as to where interest rates should be. We're not sitting there with exceptionally tight policy that needs to be unwound rapidly. And there are reasons for feeling that we shouldn't go fast. And in fact, I think, there's been a few economists say this morning that Powell has taken out an insurance policy. He hasn't necessarily reacted to the reality of where we are today. And it's not just Powell. It just seems the whole committee had a more hawkish rather than dovish tone to it. The only person was the new guy, Mirren, Stephen Mirren, who voted for a 50 basis points, but he wasn't joined by anyone else. And the real reason is that we haven't got past the peak in inflation yet. Now, the exceptional peak, of course, was COVID related, which is inside that red box. But what that COVID related inflation did was to leave us with an inflation mentality. And I think most of us would say it's not just a mentality, it's reality. I mean, here in Dubai, our prices are going up 5 to 10%, even though someone would tell us the numbers a lot lower. And around the world, we have seen very high inflation that is keeping people on edge. And it also gives people, if you're running a company, it kind of comes to the end of the year and you say, oh, you know what, we're in an inflation environment. I'll put my prices up. So that's very different to what we saw over the previous decade. And another point to make is that the Fed, it doesn't have to just suppress the current level of inflation. It has to dampen inflation expectations. And the chart on the left there shows consumer or the households' expectations of inflation for the next 5 years. And you can see it was rock solid there at around about 2.5%, 3%. Then we went up for COVID, yep. And then beyond that, it's hung around. And the last number, which only came out last week, on this figure went up by 30 basis points. So the household sector is saying, my income is being squeezed. What you then do as a wage earner, then you then go or try to go to your employer and ask for a wage increase. And then that reinforces the inflation. So this is what the Fed has kind of got an eye on. The other important point to make is in that gray box at the top is that the Fed rarely gets inflation forecasting right. The line for the PCE deflator, which is the number that they tend to focus on, is the Fed forecast at the top. So for 2000 and let's just take 2024, they forecast 2.4. The actual number was 2.8. And the inflation number for the whole economy was 3.3. And in about 80% of the time of the last few years, the Fed's forecast has been too low. So at this point in time, even by 2026, their inflation forecast is 2.4, which is above the number that they're supposed to feel comfortable with, which is much closer to 2. And by the way, the impact of tariffs has not really yet set in. I've got there in red. The most important announcement of recent months was the implementation of a significant increase in tariffs for a large number of countries on the 30th of July. There's no way that by the end of August that everything's in prices. In fact, only a tiny fraction of the impact. And in fact, if we go back in history and looked at the previous tariffs that were introduced by President Trump in his first presidency, the increase in inflation took about 6 months. And in fact, in the case of the May 2017, it took a whole year before that got fully priced in. And the increase then was around about, over 100 basis points on the level of inflation. And then there was another tariff that was introduced in early 2019. And again, it took 6 to 9 months before we saw the peak in inflation that came from those tariffs. So the idea that we would have everything priced in 1 month, of course, is crazy. We're going to have to be patient. And I think that's why the Fed will be circumspect about cutting interest rates, particularly aggressively. And if you look at the bottom there, in that dark box, these are the consensus forecasts for inflation into 2026, which still have us at close to 3% at the end of next year. So the other excuse that might be given is that, by the way, we're worried about unemployment. Well, the unemployment figure today is 4.3%. So that is not a big worry. I think that what they are worried at is that the numbers that we've seen recently have shown very little employment growth, which I would say is almost, in a sense, good news, because that's going to be deflationary or disinflationary. But it largely comes from some of the migration issues that we've got, and I'll come on to that in a second. So we think there are three factors working in the labor market today, which just make it extremely difficult to work out, will this create inflation? Are people really losing their jobs and becoming unemployed? On immigration, just the very simple numbers, and I'm quoting from studies, and of course there are a range of studies out there, but they think that the population of the United States this year on migration will be minus 2 million, as compared with plus 1 million or plus 1.5 million in the previous 3 years on average. So we have got far fewer people going into the labor market. And of course, they're literally lifting people off the street at the moment, and that will create job openings if there's someone prepared to do that job. The migration issue is going to keep unemployment rates down. Tech change will increase the number of unemployed because we're seeing a very significant drop in graduate employment. It's down by about 15% at the moment, and you can kind of come up with your theories, but there's clearly AI is having an impact because jobs that could be done by a fresh graduate with little experience, people are finding technology ways of taking that job and basically saying until you've got 4 or 5 years experience, you're in a sense not employable. And then the third point is aging populations. And here there are pluses and minuses. There's an aging population where people leave the labor force because they've all got good pensions and want to put their feet up. And there's people who, an increasing number, who say, no, I want to keep working. It keeps me fit, keeps my mind fit. And, what is 65 or 60 anyway, in terms of a whole life experience. So we are seeing more people making themselves available for work as a consequence of some of these factors. So, as I said, the labor market is dynamic, and they're working hard to try and find out what the underlying trends are. For sure, there are fewer jobs being created at the moment, but I don't necessarily say that therefore means a recession requiring very loose monetary policy. So what is it that the market's saying post the rate cut that we had yesterday? Well, there was quite a drawing back of expectations, to be fair. Before, a lot of economists were saying, well, we're going to have a rate cut at each of the next meetings. Well, that's not quite the case any longer. And in fact, if you go out to the number, which says number of hikes and cuts, and you look at the figure for March of next year, that's saying that there would be, probably 3 rate cuts, whereas before that might have been 4, and that we consistently see rate cuts. And indeed, if you look at the whole of that estimate and look to the far right, you see that in July of 2026, that the implied rate is 3. Now, the 3 is very important because that's what the Fed believes is a neutral rate of interest rates. So prior to that, we are still going to see in economic speak, relatively tight monetary policy, relatively tight monetary conditions to potentially constrain an inflation problem. So how do we take this and translate it into what's happening in markets? Well, one of the things we're going to have to face in the coming weeks is what I call the risk premium for longer dated bonds. So I've got my cash, I know what's happening to that, but the risk premium for buying a US bond is going to increase the more that they don't reflect on the huge deficits they've got and do something about it. And we have a deadline on September the 30th, where beyond that, we could see a closing down of the government, because unless they lift the debt ceiling, the government will not be able to function. So we are going to have noise as we end this month and into October, and we're going to probably have stop gaps. And then there's a kind of crushing time at the end of January when they really do need to get something passed. So that leaves the debt to GDP of the US still at an incredibly high level, certainly past relative to history. And remember all those charts I showed you earlier, they were at times when there was nowhere near the same kind of constraint on government spending. So I would say that, let's just say the US economy had a severe recession for whatever reason, they can't go and boost spending. So one of the things you would say about bonds is, well, if they can't boost spending, they're going to have to cut rates more aggressively. So if I was sitting here talking to you in a few months' time saying there's a real crushing risk of a recession here and inflation is disappearing, then I think bonds would be your friend. But that is not the case at the moment, because they would have to cut interest rates aggressively because the government would not be able to save the day with the massive increase in spending as we saw during COVID or during the financial crisis. So let me just go forward to the rest of the world to just quickly summarize this story. A series of lines here. You can pick out the one for the United States, which is the blue one. And you can see that although we've seen what has not been spectacularly great growth, but it's been good growth. And it's been good growth, but in part was due to capital investment because of technology, and in part because of the tariffs, because people were buying product ahead of price increases. But in general, the mood around the world has been relatively positive, but not ecstatic. So this is the degree to which economic activity in different parts of the world have been above or below expectations. And so more recently, most of those numbers have been positive, except for China, which is still struggling to kind of re-accelerate after what had been a good middle April, May time that we had in terms of the data flow. But I would generally say we've got good growth, but not great growth. And we've also got relatively low inflation. So if we take the US out of all of our thinking on inflation, everywhere else, numbers are okay. Numbers are sometimes better than expected, but in general, central bankers have got the ability to be cutting interest rates going forward. So ECB has already taken down rates, but the ability, I think, of some of the central banks out in Asia to cut interest rates, they might just wait for things to calm down. But we're going to be facing, as investors, an environment of relatively benign, low inflation, allowing central bankers to either maintain interest rates at low levels or cut them still further. So what do we do about this, and how would we kind of summarize the outlook for the Fed? Firstly, the Fed has the scope to cut interest rates and will be doing that, but we haven't beaten inflation and we don't know how much inflation is going to pick up. So I think when you see those forecasts, I will put if I said, look at that forecast, but keep in mind there's a great risk, and the greater risk would be that they would not be able to cut interest rates as consistently as the markets are talking, and maybe not at all, because if we go through the next 2 or 3 months and we get a surprise on that inflation to the upside and the labor market's still muddling through, they will not be so urgent to cut interest rates, because otherwise it would undermine credibility and it would force up long-term interest rates. So how do you invest for this? You think global, not US. We have our concerns about the dollar. We're still active buyers in our own portfolios for China, Japan, and Korea. Those two markets of Japan and Korea have the significant corporate change going on. And clearly, when people think about tech, they're switching away from NASDAQ, or not necessarily taking money away, but new money for tech is going into these markets where they think that the valuations are cheaper. There's a lot of money to be made out of active management. I'll give you 2 examples. In Korea and in China, we've had funds on our buy list that have done double the index over the last 12 months. So it's still not the case that you can buy an active manager in the United States and add a lot of value, but people are finding a lot of added value. And that's why when the index is up 10%, you think, well, it's just modest, right? But if I told you the fund was up 20 or 30%, then you would see a greater opportunity to invest. And that's what Asia's delivering at the moment. The third point is on private credit. It kind of gets a bad name, but I think it's wrong in one key respect. Private credit funds that have been through the last 15 or 20 years with consistent returns, there's nothing remarkable about what's happening today. And we're not talking about interest rates getting into double-digit levels. So I think there's a good space in a portfolio. And I'm much more comfortable with private credit than I am with fixed income when I've got inflation around. And my inflation hedge continues to be gold. I mean, I've talked people up from what would have been 2 or 3% in gold to 5%, and those at 5 going towards 10. And I would also include broader commodity exposure, because if we have longer term inflation, we'll have longer term higher commodity prices. And for a later day, probably some of the safer REITs, because people are looking for income generating assets where they're not going to lose capital value. And of course, if interest rates, market interest rates were to go up on bonds, then you'd be losing money on your bond markets. And just to give you examples of the REITs, sorry, of the alpha and of private credit. So my favorite private credit funds on the right. This is consistent performance since 2009. And on the left is my favorite China fund, which is in white. And you can see the spectacular performance. I mean, good managers, but there's been a great opportunity to exploit in China and in Korea over the course of this year. So to summarize, I'll just take it off share, but to summarize, we have a challenging time in the United States, but the United States is not the whole world. We have to keep that focus. There's a lot of money going from west to east. Mercer's came out with a study, which is on Bloomberg today, saying institutional money managers are looking beyond the borders of the United States for investment opportunity, and Asia is going to do well out of that. But it's really important that the whole focus is not just on buying equities, that you look to alternative asset classes such as private credit and the precious metals and broad commodity space. Back to you, Dave.
Good. Thank you for that. But before we switch over to Marshall, that was obviously entertaining because we've just got a whole bunch of questions that have come in that we'll deal with at the end. Mercer's might be saying that the United States is not the whole world, but I'm pretty sure that's not what Trump is saying. Okay, so guys, I want to introduce you to Marshall Jen, or Professor Jen, as he's known as. He's an executive director of the Chinese University of Hong Kong Center for Family Businesses, but he's also a founder of a business called FIBI Advisory, a research institute based on family advisory firms, in particular around succession. Marshall, welcome. And the aging population is causing some opportunities for Gary. I'm sure in your line of work, the aging population is causing a lot of opportunities for you.
Yeah, well, definitely. Especially since the Wahaha situation, there has been a lot more people who's looking into governance and really, thinking about how they can govern the family for succession, and aging population, of course, is going to be it's one of the big motivators for first-time entrepreneurs who's looking to pass it down to their generations. Yeah.
Cool. So do you want to go ahead maybe and go through your presentation and share with us? I know you got a couple of slides you want to share and go from there.
Sure. Yeah, perfect. Sounds good. So, I've been thinking about today's sharing, and I think one of the kind of the mystery that's still kind of out there, it's like some people seem to know it, some people don't, is kind of like why succession fail, or like why that whole thing about sleepless to sleepless in 3 generations. And really, in the succession process, there's a lot of guesswork. And if we were to go into, literature review, like Kessler and Sabora would say, ambiguity frequently precipitates, post-succession performance decline. And Lansberg would say, the role overlap and the unresolved emotional dynamic would derail the transition and stuff like that. But I'm not here to read off slides to you. Leave the boring stuff for my team, and my research team will continue to work on the reasons why. What I'm here to do today is come back to you guys with like the practical stuff of like how do you actually take the knowing what the reason of successions, like the disruptive factors to successions, like perceived unfairness and ambiguity, and what can we really do about it. But succession is a really, really big word, right? Because there could be so many different contexts, there could be so many different approach, and insurance is probably just as important as trust. Establishing a trust is probably just as important as mitigating, strategizing your wealth. And if I was a first-time entrepreneur, how I would react to Gary, a professional, in this space, I would probably quickly go and talk to my IM, go to my IC, and I would probably have a very quick communications. But when the second generation comes in and hears these talk, there's another layer of things that kind of becomes an obstacle. in making decision, and it slows things down. There needs to be new information to talk upwards to the next generation. Whether this asset class could be included as part of the family portfolio. There's a lot of things. So succession is a really, really big word, and depending on where you are kind of going in at, that's going to be a problem. So just to kind of quickly bring alignment for everybody, this is adopted from these European names that I don't really know how to pronounce accurately. But here it's trying to say that when the firm, whether it be a foundation or in business or an office, kind of moving forward and passing it down to other family members, how the size, power, culture, capital, and the change evolves. And in my work, I work on ensuring that the competency is there. I work on ensuring that the next leader is ready for it. And so today I bring to you kind of this model that I have in working with families, and I hope that by sharing with you a little bit of my secret sauce, that you guys can take this back home and you can try it out yourself, or even just have kind of thought leadership around it. Succession is a process. There will be an end goal, but it's a very, very long process. And each point of the process will determine the success rate of whether it can smoothly transfer. Now, there's a lot of social science behind this as well. There needs to be incorporated with, business acumen, because when our audience here listens to Gary and decides to invest, you guys are going to make a lot of money. But when that huge chunk of wealth it's being passed down to the family member who doesn't have the same business acumen, what do you think is going to happen? Not very good things. And so it's a process where it's a step-by-step guidance to kind of educate the family member, because there isn't really so many choices to your successor, and bring that alignment together. One thing that I always talk about with families is that do you treat your children as a chess piece that in the business he or she becomes one part of the role, or do you empower them to kind of chase after what they want? That specific mindset is very important, and usually they jump back and forth, depending on the mood, or depending on the situation, or depending on who they talk to. So this model that I'm bringing you here, that feel free try it out yourself, allows that flexibility to close the gap between the generations and then opens the opportunity for communications. So this is a 4-step model. So the first model is called the Phoebe talk, and basically what happens is when you're in a family, that's also in a business, when the family is also in a business, the dinner table talks becomes different. Rather than asking how you're doing in school, or how are you today with work, there's some kind of always business talk that comes to the table, and that would change the dynamic between the first generation and the second generation. But at the same time, because the first generation had built the wealth for the second generations, the second generation has acquired the opportunity to learn the so-called best practice out, the US or to the UK, or even in Hong Kong. But the thing is, when they only see what's amazing out there and they miss out what's happening within, they will continue to try their best and use the best effort to bring what's best outside into a company that may not fit. Now, why wouldn't it fit? Because the management philosophy could be different. The next gen may not know what the strategy is. The next gen don't know what the business vision is, and all he was trying to do is take what he learned from MBA or BBA and come back and try to, contribute, right? So that already is a miscommunication. So the first step is to do a coaching. So it's incorporating of executive coaching as well as an investigative type of project to allow the next generation to understand what the family has gone through. It could have started with the family just wanted to build business as a shelter for the family, and the parent didn't even know it was going to become a multi-million-dollar business. But that kind of process of understanding the upbringing of the family will also drive and allow them to see the family values, the family commitment, the family vision, and if they were to have a philanthropy, it will most likely be something that can't be donating towards things that that has shaped the entrepreneur themselves, and a lot of the time it starts with an endowment. So doing this kind of allowing the next generation to do this kind of investigative project through a coach will allow them to appreciate more of what the last generation have done, rather than allowing to free roam and just kind of live the best life out there and drive a Porsche in Canada to go to school. This gentleman name is Homusta Shi. He has gone through a model for his third year in already. He's already back to the business, and among all the siblings, he really got a chance to try different things within the family, and one of the reasons because he dad's things that he really knows him. So the first step is to conduct this report, and it's not good if like you just do an investigative project and you do nothing with it. So here in the first stage, every end of the stage, you would always create a family assembly, and the family assembly could have all the different modules in the event, activities in the event. But what I usually do is right after lunch, when everybody's relaxed, that we will have a session for the next generation to share their story like a TED Talk style, and just share back to the elders or to the other family members and say, oh, this is our family story. So rather than saying, oh, this is what I found out, this is our family story. So he feels like he is also trying to create that identity that he is a Shi family. Shi as in his last name. And that allows also for the elders to see, oh, does he really know me? Does he really know what happened within the family? And when he does, it's a safe space, it's an open communication space for the elders to also go back and say, oh yeah, well actually this part of the story is a little bit off. Actually, what happened was, and sometimes, most of the time, sorry, the elders would correct it because there's more skeleton in the closet. But that's kept still within the family and allows that when the next gen feels like, oh, that skeleton has been told, oh, that trust has been built. So that's the very first part in ensuring that the next gen knows and is able to truly say, I am a part of the family. Then the next part of it is being very neutral and not commenting, but demonstrating a full understanding of the business. A lot of the next gen I deal with, the family are very entrepreneurial. I think much like a lot of the audience we have today, and whether the entrepreneur started with building a school and leveraging the school as a resource to have constructing companies and accounting firms, or a family that started with property investment and then later building a mall and then building a school, there will always be reasons to expand and diversify, because that's the way entrepreneur is. So by bringing this next gen to go into understanding what the whole business operation looks like, also allows him to see the evolution of how the business came to be. And I remember one of the next gen that I work with has a very strong feeling about one of the division not closing down one of the division and losing losing about several million Hong Kong dollars every year. And they're in garment and textile. And so he really wanted to bring that comment up to the end of the family assembly, and I told him not to. Rather, go and talk to the division head and see what happens, and see why this division keeps losing money. And it turns out that the division head has been with his father, the patriarch, for over 30 years in the development of the business. And this division was really the only thing that he can do. And because he's so old, he couldn't go to other divisions. So the dad decides to just kind of keep the line open until he leaves this world. So there's a lot of emotional engagement as well. And if you take over the business and you go and fire everybody that you don't think fits, then that actually creates even more conflict for the family business. So understanding the full business operation, understanding the people is the next step to this model, and just being neutral and presenting the facts back to the family assembly at the end of the stage, and then allowing, again, the patriarch, allowing the person who is in charge right now to hear that, oh, you do understand what is happening with the family business operation. So again, another open communication in the family assembly to talk about things. Then, after knowing the kind of the family upbringing, the family evolution, as well as the business evolution, you can kind of see what can be improved. And what really happens between the entrepreneur, how people do business in the first generation, the second generation, is that the risk tolerance for the first generation is usually higher, right? Because they've got nothing to lose. They came from nothing, so I'll give it a try, see an opportunity, and I'll take bold risk. And the mindset is, if it doesn't work, I will make it work, right? I will be pragmatic and I'll focus on the result. And there's this beautiful term now called lean business model, but basically working with minimum resources, right? There's a lot of trial and error. So it's a very survival driven entrepreneurship. But we've got to understand that second generation, when they come across running a business and how university teaches them, is that, oh, it should be aspirational. We should have some kind of social aspect. And it's about solving the global problem. And these are the things that they get taught, right? They get brainwashed in school, and so this is the stuff that they will come back in. So it's more of a glory-driven entrepreneurship. So how do you really be pragmatic and close the gap between these two expectations? Is you find a very, very small, small project, or I find a small project for them, and they work on one problem of that division, and allow that next generation to kind of have that strategic mindset and be able to take minimal risk and try to turn the game around, and allow that track record to happen, so that he is engaging in conversation not just with the first generation, but with other professional managers and employees within the business, and starting to build up that position from within. And then again, at the end of this model, there will always be a family assembly. He will learn the best practice of what's happening outside. He will explain that little problem that the patriarch and I have already agreed that this is a problem that can be solved. But he's also not, the patriarch is also not giving him the business and just allowing him to run it. That risk is too high. So if he loses out, or if he's not entrepreneurial enough, it's only a small part. It's only a division, and that division, that division is not working out anyways. So that's kind of the third model. And then lastly, because the next gen would have known, the family upbringing and would have known the business kind of understanding and tried out different things and see if he likes going back into the family business. And usually, statistics says that 70% of next generations do not want to go back to the family business. But within that 70%, if you change the question and you ask them, if you come back to the family business and we allow you and we give you the flexibility to innovate and do whatever you want, would you still come back? And that within that 70% that says no, 70% of the next gen would say, yeah, I would come back. And so here it's really about mitigating risk, right? How do you pass down the business without, but making sure that it works out. So the next gen by now would have already known the family, would have already known the business, would have known the people, and would have tried to work something out with a division of the family. But if he's entrepreneur and he really looks into the future, then he would also see, macro trends like what Gary had presented, and he can have a playground like a single family office and start building out what that single family office can look like. Is it investment? Is it education? Is it philanthropy? And by allowing him to build that, you also empower him to have the ownership to build up a family office, a single family office. And as the father continued, or as the patriarch or matriarch continue to age, you will see that after the family office has been established, that you can also distract the patriarch to come down and work on the family office, so that it allows that capacity to open up for the next generation to go back up. So this is a model that I've been that I've worked with and worked on and continue to improve it over the since COVID, and it really helps the design to open up conversation and allow these successor candidate to include the intention through casual conversations and open up opportunities to deepen that connection with the family legacy, and also as well kind of training on their business acumen and getting endorsement from other stakeholders. And now, you guys probably still don't really know who you're talking to. It's like, why is this guy talking about education? Well, education is one of the ways to go into helping with succession, and that's kind of what I'm. My whole undergrad is in curriculum development, and leadership management is one of my key research. So this whole structure in how succession could be pinned down is called governed learning. So governed learning and governance refers to a structured, disciplined, and intentional process that helps to improve decision-making strategy and operational efficiency. And that would be my sharing today, and I hope that it can give you guys some inspiring insights on working on your succession for your family. Back to you, David.
Thanks, Martian. Well, I guess a couple of things, we're all about really about entrepreneurs and families helping to protect their wealth legacy. And I guess a couple of things to point out is you might have the handle professor, but Martian's not a professor. I've gotten to know him. He's actually an entrepreneur, and his origin story is essentially the pain point of being a second gen and going through the family and having his own businesses. And he's found shelter temporarily under the guise of a professor, but I can see the entrepreneur trying to sneak out through it. Marsh, we had a good chat the other night, and I've got a lot of different families. I guess a couple of things that come to me about that is, when I talk to friends of mine who are second or third gen, I see two things that come through. One is the decisions they make, both in business and personal. They always go back to a sort of a family of origin decision-making platform. Do I turn left or do I turn right? What's my family of origin decision-making platform? I guess where I'm going with that is, like, when do you get involved with these second gens? Are they coming out of university? Are they going into school? Is it on the conception table? I mean, where do you get involved?
Yeah. I would say that it really depends on the sophistication of the family. If the family is really sophisticated, each of the stakeholder is very sophisticated, you could actually start doing succession planning and seeing the family as a unit to build on succession. But a lot of the times, because I deal a lot, with Asian families, the kind of the penetration point to help with the succession is on the individual. So I work on the individual as a succession point, where I would go in, at the age of 15. That's when they're grade 9 moving into grade 10, and I start talking separately. I talk to the parents about, how do they see their business? How do they see their wealth? What do you want the kids to become? And I would do an 8-year plan for the individual from the age of 15, and build them towards that role. But then, again, going back to, if the family is sophisticated enough, then yeah, you could just start off with family governance, talk to all the stakeholders, build a rule, build a structure, and start governing the family as a whole, and bring alignment together. I think that the worst part about secession is that people think they had done secession because they had done their will, they had built their trust, but there's still no alignment. And so when they pass away, infighting starts to happen. And I didn't show it on the slide here today, but I mean, over the past 2 decades, I think we have seen, publicly, we've seen like Great Eagle, Chevalier, SEAL Team, right? All of those guys who have done all the tools, but still couldn't do succession properly.
Yeah, no, I don't think we should underestimate the pressure. I've got a very good friend of mine, very successful second gen here, and when we catch up, I always laugh. But, we catch up with the jockey club, at the owners and he always says to me, Dave, if I fail, it's all over the jockey club. If I'm having a bowl of ramen in Kowloon side. And I remember I said, what about me? He goes, nobody gives a shit if a Dungualo fails and eats ramen. That's how it works. But Gary, can we turn it over to you? I got a bunch of questions just in the last 10 minutes, if that's all right.
Yeah.
So, all right. So, I mean, somebody's asked a question, what's your view on the level of dollar hedging? So the statistic today, I don't know where they got this from, was of the last 3 months, $7 billion into the US, but 80% of that is now dollar hedged, as opposed to the average being 25%. So that's what show of lack of confidence in the dollar, but a confidence in the stocks. How does that work?
Yes, for the moment, but obviously we've had this unidirectional falling of the dollar. Sometimes it's fast, some days it's faster than others, and sometimes it's a modest recovery. I think when people look at levels, I was with a lot of currency people yesterday, and the general, I said, I don't play consensus, but everyone's could easily see the dollar down another 7 or 8% from here. I think the problem is, I would call it benign neglect of the dollar, and maybe with a true intention of getting the dollar down. That seems to be what the administration wants. That's what they've articulated prior to taking office, and people kind of didn't want to believe that. So I would say that you do need to hedge. Your hedging is not just for the next few months. It's for the entire the next 3 years of the governance of this presidency. And remember that it's taking some time for some of these characters to come to the top of the tree. So to give you an example, some of the people who are economic advisors who may even end up leading the Fed could be in that camp that it will be quite happy to see the dollar fall. So Mirren was voting for 150 basis points, which sounds great. 50 basis points cut, which it sounds great, supportive of the economy, but it's also mindful that, yes, and this could get the dollar down and make us more competitive, or potentially mitigate some other elements of the weakness, which has been driven by the uncertainty. So take it all together, you must hedge. The dimension of downside risk is still 10%, even though we've already had almost as much as that in these early months of Trump's presidency.
Okay, well, I guess those next two questions are going to lead into one. You mentioned in the, I'm going to paraphrase the question, there's a lot of words here, but basically the Fed always gets inflation wrong. So now we're going to have the dollar devalue, the Fed get inflation wrong again. What does this mean for the consumer? More pain?
Yes, it is. And, well, quite honestly, the little man in the United States is getting beaten up hard, right? So there's no wage growth. There's the high inflation, and most of the tax and much of the spending cuts, if there is spending cuts in government, are taking away some of the benefits which would say are just a universally required, such as healthcare. And the tax breaks are coming at the other end. Now, everyone gets the vote, but they won't get the vote for another 3.5 years. So I don't think you're going to change this. Now, it can only get worse if there's a kind of virtually people on the streets protesting about it and they do something meaningful in terms of policy. But the direction of travel, unfortunately, for the central bank is to be looser on monetary policy, not because that's expedient for economic reasons, it's expedient for political reasons. So yeah, the small person with modest incomes is still going to get hurt.
Yeah, I mean, the populists have been dumbed down. We have the National Guard in California, and now we have Memphis. And I noticed you then mentioned that the tech, graduate employment is, and again, 15%.
Down 15%. Yeah, they're not finding jobs because they can't command a job with the skill sets they've got. I mean, education system will change, I'm sure, and we're going to get AI experts who come to the fore. You're a graduate and you're an AI expert. And I think we're just in that middle where people are coming out with the conventional degrees and are not relevant to the kind of skill sets, or do not have the skill sets that these companies want at the price level that a graduate thinks he needs to get paid.
A question here is, Gary said that bonds are not your friend. Who is?
Bonds in the US are not your friend. I should have been very specific. The problem is that ex-US, ex-dollar, you can't find very many deep bond markets. And I think in a sense that's an opportunity, because that means that Asia should be raising capital and needs to go onto the front foot, because I think there are willing buyers. But at the moment, as I say, the lack of depth of the markets in other bond markets means that those asset classes are not so relevant to the asset allocation of a global investor. But I think that will change. And I think that's where the private credit markets are playing their role here. So as I said, I'm writing off US bonds purely because of the benign neglect of bringing inflation under control and remaining credible on fiscal policy.
Excellent. I guess one of the things that came from me when Marshall put up his grid of the families, the first time entrepreneur, the second entrepreneur, the protection, and the last piece of the equation was revolution. It just felt like that's where we were with the US. Anyway, thank you very much, everybody. It's a good call, good information. We'll kill it there. If anybody wants to learn more about Marshall's, either come to your contact with an AOP. And Gary, as always, the same. Really like your portfolios, really like your questions, and really like with this. So guys, thank you very much. And we will see you all again in October. Have a wonderful weekend. Thank you. Gary.